Hey, welcome to our weekly segment where we guide you on your journey to financial literacy.
We like to make these videos short and sweet in hopes that you learn a new economic term while keeping you updated on 3 financial events that happened in the past week.
Without further ado, let's get right into it. Interest rates didn't quite come full circle in the first half, but the moves were noteworthy. After beginning the new year below 1% for the first time in history, 10-year yields rose sharply to near 1.75% in March. Since then, rates have trended lower, including a drop last week that saw yields fall below 1.25%. Rising rates in the first quarter were a function of increasing inflation worries and concerns that the Fed would have to ratchet down stimulus sooner than expected. The more recent pullback in yield has stemmed from fears the global recovery will be derailed by the ongoing pandemic. News last week that Japan has declared a state of emergency and rising cases of the Delta variant added to the dip in rates. U.S. large cap equities posted a strong start to the year, logging the 10th best first half in the last 40 years. U.S. small caps did even better amid historic GDP growth. International equities delivered solid gains, up 9% for developed market large caps and up 6% for emerging markets, but trailed due to lagging economic rebounds overseas. Volatility remained low, with just two 4% pullbacks. An accommodative Fed, encouraging economic readings and healthy corporate earnings provided a sturdy foundation for sizable upside and limited downside for equities. Employment conditions continue to heal, but the pace of improvement has stalled recently, as shown by last week's uptick in initial jobless claims. New jobless claims have been cut by more than half since the start of the year, but are still more than 80% above pre-pandemic levels. After falling from 14.8% to 6.1% between April 2020 and April 2021, the unemployment rate has ticked down just slightly in recent months. This reflects decent job growth, but a mismatch between the supply and the demand for workers. GDP has recovered pandemic losses in record times, with the first half outputs rising at the fastest clip in 80 years. Anyways, that pretty much wraps up the news for this week. Now I'm going to hand it off to Om to discuss our financial term.
This week's financial term is ankle biter, and no, it has nothing to do with over-aggressive dogs and everything to do with market capitalization. Before I get ahead of myself, an ankle biter is a stock with a low market cap. In our day-to-day lives, ankle biters describe over-aggressive dogs or even young children. The coining of the term exaggerates both of those things, implying that they are too small to even bite your ankles. With these type of stocks, it's really up to the investor to evaluate it as he or she chooses to do so. There is no defined line that distinguishes an ankle biter from a small cap stock, but there are some generally accepted rules. In general, ankle biters have a market cap under $500 million and are also referred to as microcap stocks. From an investor's perspective, these stocks, like most microcap stocks, tend to be extremely volatile and have low volume. But on the upside, these stocks can have great growth potential. In 2013, Dave Manny at Forbes wrote a very thought-provoking article called The Ankle Biter Economy. In the eyes of the news, any startup is considered an ankle biter. The writer suggests that an ankle biter economy is an economic system where technological productivity drives the economy, where the innovation only produced by ankle biters takes down large corporations who are notorious for sticking to what works. Although we do see this type of stuff happen today, the writer suggests that it will happen a lot more often in the future. Again, circling back to the point about economic productivity being driven by technological innovation. And that's it for this week's financial term. If you liked the video, please drop a like and subscribe if you haven't done so already. See you next week.